Hello, and welcome to another episode of Moneyfy Mantra, where we speak with industry experts on various personal finance topics, which can help our viewers take informed decisions about their investment. In today's session, we have a very special guest, Mr. Trideep Bhattacharya, who is CIO at Edelweiss Mutual Fund. Very warm welcome, Trideep, to Moneyfy Mantra.
Hello, everyone. Thank you very much. Thanks for having me on your show.
Yeah. So today's topic, we'll cover about technology mutual funds. I think Trideep, just to give a quick introduction about Trideep, Trideep has more than 2 decades of experience into investing into equities around both Indian and global markets. Prior to joining Edelweiss, he was instrumental in building a market-leading business of PMS for Axis Mutual Fund. Axis AMC. So as a senior portfolio manager, he's built the whole PMS business at Axis AMC. So Trideep, very quickly, so the technology has been evolving over the last 4-5 decades. So recently what we have seen is the banking transaction or the investment transaction of all the investors. These transactions now happen over a click of a button. Previously, these transaction would that there was a time-consuming process where a lot of paperwork was involved for doing such transactions. So similarly, there are multiple categories of businesses which have got impacted because of this technological advancement. So if you could cover some history of technology, how has it changed manufacturing, consumption, and service industries in India?
I think technology adoption across industries have actually grown manifold over the last decades, and it's actually kind of got further pace if you look at during COVID times. The example that I would give you is actually not from India but in the United States. In the United States, online retail sales as percentage of total retail sales, online retail sales meaning the e-commerce or whatever buying that we do online, that took about 30 years to grow from 0% to 15%. So online retail sales in 30 years went from 0% to 15% of total sales in the United States. And during COVID times, in that 30 months, it went from 15% to 30%. So an entire 15% jump in just a matter of 30 months, even though the same amount of transition took about 30 years earlier. And we are talking about the most experienced economy in the world. What this shows as a clear example is the pace of technology adoption that has increased across geographies, across segments, across time frames. The second example I would tell you is that imagine you are an automaker. And as automaker over the last 100 years, what one has excelled in is making how efficient the engine is likely to be. And that's where most of the automakers in the world over the last 100 years have focused on. But by a flip of a coin, what we have seen over the last decade or so is the transition from ICE engine to an electric vehicle. Now, while the heart of an ICE automobile is basically the engine, the heart of an electric vehicle is the battery. But think about from an automaker standpoint, his area of expertise has completely changed by virtue of this trend. This also shows that not only tech has transformed industries, it has also disrupted many existing ones to make way for new, better, and efficient ones. This is the difference that technology has brought about across industries, not just in India, but globally. I can go on and on, but the fact of the matter is, the sooner we understand and adapt to this trend, the better it is for us as individuals and us as investors.
Correct. So I think, the scalability of the model for every business now is dependent on the technology. So I think, in a country like India, where we have 140 crore, population, so it becomes very critical for, such adoption. So, coming to the next question, what are these technology fund and how is it different from a large, mid or small cap fund?
I think the first thing that I would think about, or I would say to your investors, is something like this: that when we are investing in a single country multi-sector fund, which is a diversified fund, whether it's a large cap fund, a multi-cap fund, a mid-cap fund, what we are doing is we are only investing in India as a country, but we are using diversification across multiple sectors. The fund that we are talking about, which is Edelweiss Technology Fund, we have reversed the concept to a certain extent. Here, we are talking about one sector, which is technology, but we are we are diversifying globally. So through a combination of 70% India listed companies and 30% US listed companies, we achieve geographic diversification, but the sector remaining the technology sector, and the importance of which I described earlier. So all in all, it's a different type of diversification. It's a different way of approaching the same concept, but it improves the Sharpe ratio dramatically. What we saw and in the backtesting data is that when we mix Indian listed stocks with comprising 70% of the index with 30% US listed stocks and build a concoction of the same, the risk profile of that portfolio goes down by 200 basis points as compared to a simple Indian listed IT services company's portfolio. And not only that, what we found is over a long time horizon, like 10 years, it adds 2 or 300 basis points to the returns as well. So on net balance, it increases the returns and reduces the risk, which is the ideal way of diversification. On net balance, the diversification between 70% India and 30% tech in the form of tech portfolio actually enhances the return, reduces the risk, and thus improving the Sharpe ratio. So hopefully this example, the way I talked about it, gives you a sense how it is not only different from large, mid, and small cap portfolios that investors are used to in the context of India, but also provides geographic diversification, and third, improves the Sharpe ratio of the product.
Correct. So, so what are these types of companies, which would get covered in the technology fund?
Right. I think it's a great question. So I would say that, as I said, there are two parts to this portfolio. 70% of the portfolio is stocks listed in India, and 30% of the portfolio is stocks listed in the United States. The stocks that are listed in India, which form 70%, comprises of two further subcomponents. One is the traditional IT services, like Infosys, TCS, and the likes. But it also includes companies which use technology as an enabler to disrupt an existing business model, or maybe uses technology to catapult itself into the sector meaningfully. For instance, when we are talking about food aggregators, Zomato, or when we are talking about insurance, Policy Bazaar, these are names of companies which have now become household names as they have leveraged technology to make their presence felt in individuals' lives. Likewise, there are companies who are using technology to participate in defense, which is one of the high growth areas from an India standpoint. So when we are referring to the India technology component, we are not only limiting ourselves to the technology companies like Infosys, TCS, we are also diversifying across, or we are also including companies which are what you call as new age tech companies. In other words, companies that use tech as enabler to kind of, to catapult their growth in the sector or disrupt the sector. Likewise, in the global component, which is the US stocks, the way we go about that is what we are looking for is investing in global industry leaders in the form of a subsegment of S&P 500, which is where we are kind of, picking the stocks from. So on net balance, basically rule-based investing in the case of 30% of the portfolio, which is global, and active stock selection-driven portfolio in the domestic component of the portfolio, which is listed in India.
Correct. So, there are multiple types of companies which you have listed down, and there'll be some key parameters, as you rightly mentioned, the disruptors in the market. And today what we have seen is in India, a lot of these companies not struggling to right now make profit, but they have a scalable business model. So what are your exact key parameters for shortlisting of some of these companies?
Yeah, I think it's a great question. So I think even though it is a thematic fund, even though it is a sectoral fund, some of our broader principles, which we are using across more diversified portfolios, which we call as FAIR, which is forensics, acceptable price, investment style agnostic, and robustness of the business model, those principles still apply while we go about stock selection in the technology domain. Now, while I've named you the four pillars of what our investment framework is, a couple of important ones that I would highlight here are: number one, the company should be financially clean. Number two, basically, it should have robust business model. And when I say robust business model, I'm talking about the company should be generating cash flows and return ratios apart from purely growth. So, it clearly we would be careful while picking new age companies, and we'll include those which have an element of profitability in them. We are investment style agnostic. So between value and growth, we could pick either, depending on where the risk reward balance is looking favorable. And finally, overall, we would look to buy stocks where we see at least minimum starting upside of 20% or more. So all of these principles applied to the tech sector in the context of India is what we will use to select stocks, and those would be the deciding criteria.
Great. So, you've been mentioning that, a part of it will be invested in the US market. And so how big is the US technology market right now?
Well, US is the forefront of innovation of the world. What we have used US is basically a proxy for global technology. What we found based on our study is that while technology stocks are listed globally, US technology forms an important component of the same and covers almost about 80 to 85% of the global technology in terms of subsectors. And that's what got us excited about combining the Indian technology part with the US technology part, and use the US technology portion as a proxy for the rest of the world technology. Now, in the name of US tech, we would ultimately be owning about 50 stocks, which are the top 50 stocks in the subcontinent, and that are subcomponent of S&P 500, well-known names, well-known exposure to artificial intelligence, semiconductors, hardware, robotics, and will give investors a sort of exposure to those technologies, particularly in the B2C domain, which are otherwise very difficult to get in India.
Correct. So I was just looking at one of your slide, which showed how big is the so the top within the top 10 stocks of US, 8 are from the technology sector. When looking at India, the number is quite low right now. So looking at the US market, can we gauge the Indian markets or the Indian technology firms to grow further from here?
Absolutely. I mean, I think you have to only go back 20 years to see that where Indian companies were practically nowhere in the global landscape. Today, they not only have a leading market share in one segment of technology, which is IT services. Gradually, we are making our mark in EMS, or the hardware part of the spectrum overall. And I see a 20-year runway for companies which operate in this segment as well. Likewise, there are various other subsegments, semiconductors, hardware, etc., where Indian companies are in a very nascent stage. And given a bit of push from the government, they could go on to become global leaders at some point in time. So on one side, you have the global leaders in the form of tech. On the other side, you have at the moment, tiny tot companies from India, which are looking for growth. So hence, in the form of this portfolio, it's a combination of growth and experience. Growth from India and experience from global sectors, global technology leaders from United States.
Correct. So, the last question for today. So are the valuations, of the Indian IT companies preferable at the current levels?
So I think I would take this question with regards to understanding the timing of launching of the technology fund. What we found when we looked at the data, that over the last 2 years, Indian IT services sector has underperformed the broader markets by anywhere between 15 to 25%. As a starting point, we would want to be in those areas which have not yet run, particularly in a bull market like what we are going through. So it's a good starting point. Second, what we also find is that calendar year 24 to be a bottoming out year from a global growth standpoint. And we expect the global growth to rebound from calendar year 25 onwards. As a play on that, there is a reasonable expectation that earnings of the technology companies will gradually rebound as the year or calendar year 24 goes by. Not immediately, but as the year goes by through the year, and hopefully can see better days in calendar year 25. And finally, to your question on valuations, when we looked at the valuations today, basically the technology valuations still are at par with 10-year average, or in pockets actually even lower. So as a combination of starting point of underperformance, as a combination of valuations being favorable, and with the forward-looking catalyst of global rebound, we thought that this is the perfect time to actually talk about technology fund for investors.
Great. So I think we've covered most of our questions related to the coming NFO from Edelweiss Mutual Funds. So I'll just spend a minute to explain all our viewers about this, the new NFO which is being launched. So the NFO starts, on 14th of Feb, and it'll run till 28th of Feb. So the fund will mostly cover the technology companies in India and US. So 80% of the investment will go towards technology and technology related companies. The fund will track S&P BSE Tech TRI as the benchmark, and the fund will be managed by Mr. Trideep Bhattacharya and Sahil Shah. So I think Trideep, thanks for taking out time for explaining the details of the NFO. It was great speaking with you. And for all our investors who are looking for investing in the technology as a sector, I think this is one of the better NFOs to go for. And if you wish to invest in this fund, you can download our Moneyfy app. We have given the link in the description below. You could start with SIPs as well as one-time investment. And if you have any other question related to the NFO, please put a comment below, and we'll be happy to help you. Thanks, Trideep, for valuable insights on this.
Thank you very much for having me on your show. Hopefully, your investors are convinced. As an AMC, we certainly see this as our Valentine's Day gift, and hopefully they take advantage of the same as the NFO starts on February 14th. Thank you very much.
Thanks, Trideep. Thanks, everyone.
Thank you.